The latest market crash has left investors and businesses in a panic mode. From cryptocurrencies to global stock markets, the markets are stressing all of us. Hi, I'm Diksha, and in Kalkine Media's educational series Explains, today we will learn what a bear market is and uncover its details in depth. What's a bear market? In securities and commodities training, a declining market is known as a bear market. It is based on a speculative transaction called selling short. A bear is an investor who expects prices to decline and on this assumption sells the borrowed security or commodity in the hope of buying it back at a lower price. To give it some stats, we can say that a fall of 20% or more in securities prices amidst widespread pessimism and negative investor sentiment translates into a bear market. It can be cyclical or long-term, where the dip might last for several months or a couple of weeks in the former and could last for a few years in the latter. Inverse ETFs, put options, and short selling are a few ways in which investors can make money during a bear market as prices fall. Bear markets versus corrections. These two should not be considered similar. It is because a correction is a short-term trend that has a duration of less than 2 months. Corrections offer a suitable time for investors to find entry points into stock markets, whereas bear markets rarely provide suitable points of entry. This happens because it is impossible to locate the bear market's bottom. Bearing with the losses can be an uphill battle unless investors are short sellers or they use other strategies to make gains in the investor market. Stages of a bear market. The first phase is categorized by soaring prices and high investor sentiment. By the end of this phase, investors begin to drop out of the market and take in profits. Secondly, stock prices begin to plummet, trading activity and corporate profits fall sharply. Even economic indicators start becoming average. This is when investors begin to panic, and it is referred to as capitulation. Third is when speculators start entering the market, consequently raising some prices and trading volume. In the last phase, stock prices begin to drop slowly. When these prices start attracting investors again, bear markets start to lead to bull markets. Here we have defined what bear markets are. Know more about finance in our next video. If you like this information, you could like, share and comment on the video. For more informative videos, subscribe to our channel and press the bell icon. This is Diksha Singh for Kalkine Media.